What's up? I'm Dan Fredenberg, and this is another Chance Encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. Today with Paul and Amy Griffiths. How are you doing today?
We're doing great, thank you.
Doing well.
Excellent, excellent. And I got some great news for you. I don't know if the two of you are aware of this or not, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors, passive investors, buyers, sellers, all that kind of stuff. And you might ask yourself, well, why do you do that? And the answer is, if you've ever heard of a private off-market deal, these are often ones that you're not allowed to publicly discuss, then you should know that the SEC and securities attorneys are going to insist that you have documentation of your prior substantive relationship, or else the SEC might get ants in their pants and they might take away your business in the form of rescission. That's bad. So I have people on here and we talk about their core competencies that they contribute to deals, what their buy box is and that sort of thing. And the benefit for you to watch is that you are going to learn how to more effectively communicate on the subject of a commercial real estate deal. But before we get into those specifics, Paul, Amy, do you guys want to introduce yourself a little bit?
Hi, I'm Amy Griffiths.
Griffiths.
We're with Amsterdam Corporation and here in Southern California, and we're really glad to be here today.
Awesome, awesome. I think that was good enough, Paul. You're good with that intro, Paul. You don't have anything else to add?
No, I'm just grateful to be here. You know, it's Friday, so it's been a long work week, and we're really this is a very productive day for us. And then the weekends here, we devote a little time to family. So,
All right, good stuff, good stuff. Up here in Canadiana, some people call it. It's Thanksgiving weekend, so it's going to be a big one for us. Yeah, it's our Thanksgiving is in October because at the end of the day, Thanksgiving is a harvest festival, and you're not harvesting anything in November in Canada. There's maybe some snow and like a dog sled or something. But anyway, let's get started with the 5 distinct motivations. I've now literally interviewed hundreds of commercial real estate players, and everybody has their own unique reason why they do these deals. And I found that even though they are unique, they fit pretty nicely into these 5 different categories. But the reason why it's relevant is because before you do business with somebody, you should really know what's going to keep them from throwing in the towel when the going gets tough. And so that's why I ask this question in every interview. Now, the first motivation that I have in here is preservation of purchasing power. What's that? Some people already have a portfolio of assets and they just live off of the proceeds of ownership. And so that preservation is the big idea in their head. Now, of course, high wage, high salary earners, they're going to be shooing away part of their income every month or every year into different investments, and they want to make sure that that value does not deteriorate. And of course, whenever inflation rears its ugly head, then you're going to have to make a new acquisition. But the real emphasis when it comes to this motivation is that they're not going to be making deals for deals' sakes. In other words, every 10 seconds, they're going to wait until they get the steepest discount that's possible. And of course, everybody should try to get the steepest discount that you can, but the point is that you don't need to pull the trigger if you're in this situation, unlike a lot of syndicators and whatnot who are really motivated by their acquisition fees. And just so we're clear, this is not where I am in my real estate journey yet. What describes me better is trading time directly for wealth. I've got a background in tech, so that means guilty as charged as far as a high wage, high salary earner and all that sort of thing. Specifically, it's in the CRM industry. I opened up my own CRM agency back in 2011. And then in 2014, I started working on the full stack development, the funnels, the marketing and all that sort of thing for a real estate company out of Cleveland. And that's what taught me that I was on the wrong side of the right business. My old boss was doing 10 single family transactions per month like clockwork for years before he hired me. And what I ended up figuring out was that if you pursue these higher salaries, these higher wages, your tax bill is going to balloon just as quickly as your salary. So it makes more sense to devote your effort to being compensated in the form of deployed capital, aka equity, rather than just another paycheck. I get that that's a little subtle for some youngsters and whatnot. What tends to inspire them a whole lot more is hustling like crazy and then fast tracking your retirement. Now, of course, that might actually just mean that you want more control over your schedule, being able to take time off to be at the important events in your family's lives, different things like that. And there is definitely one issue with people who have this as their primary motivation is they might get the blinders and think that everybody is actually secretly trying to retire. And I assure you that's simply not the case. There are some people that are fueled more by ambition. They want that generational wealth to make sure that their great-grandchildren never have to hold a day job, so they want to buy their entire hometown, and that's what's motivating them. And I get that in some circles, that sort of motivation is vilified, but the fact is you need people who are not going to be asleep at the wheel. They're motivated to come in day after day to make those properties better, to make sure that residents are happy and motivated to keep renting. So they're really great people to have on your GP team. Now, of course, the other group that's also going to hustle into their 90s, it's not so much for their own legacy so much as maybe they've found a sector of society, maybe it's the environment, maybe it's animals, who knows what it is, but they figured out that there's a big financial component to making a big impact. And so that's why they're making their commercial real estate acquisitions. So maybe Paul, if you want to go first, what combination of those five describes you best? And we'll go to Amy after that.
Well, I mean, I almost would say all of them, to be honest with you, because so many, for us, I've had my parents are still working. And so there's that motivational factor. There's, we have generational wealth that was passed down from her great grandma who built early, and which we named our company after, who came to our area and built multifamily on the beach. And we have our kids went to college from the benefits from that. So there's that also, the generational side. And then, we have, we bought properties along the way. So we've grown in that area also. So, and then giving back to try to explain to investors or people that, I guess that if I knew now what then, if I could just be in my 20s and I had my first investment, I would have went into the passive investing side versus maybe stock. This is my opinion, but because it just the wealth grows and the advantages of so many things from real estate, and then not having to do real estate, as we all know that owning real estate isn't perfect, and there's sometimes we run into problems. So I would say all of them, to be honest.
I agree with that. Yeah. And I think too, the retirement one is the one where I'd say retire, yes, from our W-2, but we love this work. So I kind of feel like I don't know when that retirement is ever going to happen, because we enjoy the work we're doing around multifamily real estate. And about the part with helping people who need it, that is definitely always been part of our business model. We really believe strongly in our proceeds, giving back 10% to the community, to people in need, whatever it might be. We're kind of letting that come as it does, and we're working with people on where that can be. But that's definitely an important part, is giving back. So helping people in need. We feel really good that we are in a position to finally be able to do that in a way that we were not able to do that before. So that's that. Yes, they're all components. But I think that's one that sticks with me.
Yeah. I would like to add just a little bit. One of the other thing, I've run a business for 30 years, outside of real estate, and then she's been an educator, principal. But we built this business, and now we get to work together, and that is, and when going into groups, now we're a 2-for-1 deal. In GP teams, you get both of us on the team for actually, it's one person, but you get two.
Mhm.
So that, and we love working. It's been such a great experience so far. So.
All right, awesome. I love it. I love it. Now, it's funny because I that dovetails into the next question, and one of the things that's an issue about asking about people's motivations is sometimes people see a little bit starry-eyed, as if they're not really paying attention to the risks that are involved. Now, obviously, Paul and Amy are not guilty of that one. You know, they mentioned that it's not exactly smooth sailing all the time in real estate, but some people they have this some sort of unusual perception that that is the case. Now, if you've ever been involved in a private off-market deal, there's some kind of times called 506B deals, then whoever the securities attorney that was involved, they should have insisted that every investor, every partner in the deal, they should have filled out this financial questionnaire that's heavily invasive about your net worth, you know, your income, your experience in investing and all that sort of stuff. But when I was filling out my first one, I found one question was a little bit problematic. It was the tolerance for risk assessment question, and I found it didn't matter which of the multiple choice answers you chose, it lacked utility. So on this interview, I made my own one, which is a fill in the blanks question. It is, there are many popular investment asset classes, but I think blank is too risky. So, Amy, maybe you want to kick things off. Well, you can give inside real estate, outside real estate, one of each, whatever you want. What's too risky for you?
Um, I think outside real estate, we look at all aspects of real estate. I think all of them have depending on the cycle, areas of risk. So I think that everything can have a chance of being risky. For example, flips right now in our area are sitting a little too long, so that could be an area of risk. But I think outside real estate, there's a lot of things, and because I'm not living, breathing, and eating things outside of real estate, there could be a lot of things there, in my opinion, if I were to delve in it, that could be too risky. So I'm going to stay general with that, outside real estate, and I'm going to let Paul take that one from here, what he thinks.
I think just from the experience of and this is just my personal opinion, ALFs right now are a big investment that I'm seeing from a lot of people. But on the downside of it, that also is a business. It's not just commercial real estate. You have to depend on your staff, and if that staff fails, so you're still investing on people, which is not just real estate where we take appreciation from real estate, but that with that there's a little more risk in that. And that's just my opinion, because it's commercial and a business with people, and the people run that business. So that's just my opinion. With other people are successful, but that was one I think is a little more risky.
Yeah, that makes perfect sense because it only takes one person to ruin your facility's reputation as well. There's all sorts of horror stories about that, and as it's becoming more important in society. But for this next question, I got to confess that I did not include this for the first couple hundred chance encounters, and the reason is because I thought it was a little bit too fastball for people who were new to the industry, or perhaps they're more front of house, public relations, marketing, that sort of thing. Anybody who's not really a spreadsheet jockey, who doesn't really go in and mess with all the different fields or something like that, they might be really intimidated by this question. But the fact is, we're all curators of deals at the end of the day. So we need to focus on some of these different metrics more than others, and to decide basically which deal to pursue and which one to pass on. And for anybody in the audience who's listening but not actually watching, I list off these 14 as a way to jog people's memory about common deal metrics. And here we go. The first one is cash on cash. Second one is IRR, which stands for internal rate of return. It's also called an equity multiple. In other words, you invest, say, 100K. What multiple of that are you looking to or projected to get once the deal has gone full cycle? Next, there's the cost per door. There's the net operating income of the property. There's the going in cap rate, which is basically a back of the envelope way to find out what sort of discount you're getting, because in any major metropolitan brokerages will publish what the standard cap rate is for a particular area at a particular time. Next up, you have the loan interest rate. Then you have the occupancy, which is the inverse of vacancy. So you might hear vacancy, you might hear occupancy. It's the same number, just inverted. Then you have the average income where the property is located to give an idea of the financial stability variety of people in the region. There's the amortization period of the loan. There's the difference between market versus in-place rents to figure out how much of a boost you can get with new residents and whatnot. Then there's the population growth where the property is located, which gives you an idea of the appreciation just from increased demand. There's the sponsor record, which is how many deals have gone full cycle, how many deals are on the go right now. Then there's the waterfall split or exit strategy, as in, is it supposed to be a long-term hold, or is it supposed to be a little bit more transactional, a quick fix and flip, that sort of thing. And then the last one I have listed is the DSCR, which is debt service coverage ratio. In other words, how much of the revenue from amenities and rents are going out the door immediately just to pay for the loan. So, guys, do you want to give like a top three or something as far as what you tend to focus on?
We will not take down a property without doing every single one of these on this list. So picking three that's not something I would do. Every one of those has to be in order for us to actually get in a deal. With our underwritings, we go conservative, but every piece of that, which is, I'm going to go ahead and keep those notes right there, because people have to understand that should be the way everybody looks at the properties. And so,
yeah, I agree with what you're saying, guys. You were going over the list. I absolutely, everything you're saying, Paul, is that we consider absolutely everything there. However, I will say at different points of the deal. For example, we're looking at the market, population growth, if an occupancy, if those aren't at where they need to be within our business model, I'm not even going to start the underwriting. We're not even going to go there. So those have to be in place first if we're even going to get to look a little deeper. Then once we do look deeper, let's just say we get all the way through it and we're like, hey, is this something we want to move forward with before we even consider the sponsor? At the IRR, let's get to the bottom line kind of person. What are the numbers? What is this going to get for our investors? Is it something that's going to be viable and attractive to our investors? And so if that's in the right place, then we go with, okay, the sponsor record. I mean, we have a lot of relationships with sponsors, so usually we already know that going in, who that's going to be, but we always consider our sponsor with the market we're looking at and the numbers as well. So I think that Paul's right. It's all of those things, but it's those things in different points in different entry points.
I would also add to it, maybe path of progress is something which is, within that market population growth, but, studying maybe companies. We're looking at a market right now, we're seeing a little swing in business from state to state, and we can see that larger companies are coming in. And so maybe asset wise, you're going to have a lot of construction guys maybe in that area for the next few years. And so that's going to change how your commercial property looks at that moment. And then you're going to have those now the work people filling those jobs come in, and they're going to have a different type of, maybe a commercial property wise, so it changes. So, those metrics are part of, that 5 to 10, depending on how long we're holding assets.
I love that answer, and you definitely revealed the fact that yes, it's a trick question. The fact is that like underwriters in general, they're going to give more of a response of like, what are you talking about? Like every single one of these can vastly affect the outcome, But that's exactly how it goes. So I'm gobbling up that answer like a delicious subscribe sandwich. It's another subtle reminder that maybe you should hit the button. But that also reminds me that it's time to pull out the Dan Does Deals Commercial Core Competency Cube with the 6 different roles in a commercial real estate deal. And I go through all 6 of them so that you understand exactly where my guests will fit into these commercial real estate deals. And as I'm going through them, you might get that idea in your head saying, hey, I need to get me one of those cubes. And the good news is it's absolutely free. You go to dandoesdeals.com. There's this big conspicuous looking button. You click on it. It goes straight to the PDF. You can print it out and fold it up and glue it together and practice on your friends and family. Because quite frankly, your ability to effectively communicate is going to dictate your success in this industry, which is why I make that so readily available to everybody. Now, the first role that I want to talk about is the repositioner role. You're more likely to meet a repositioner than any other type of role in commercial real estate because they're very publicly facing. They're also deal finders more often than not, or at least curators, but they're called repositioners repositioners because they're searching for upside. So they need to do the math to find out how they can make this property more profitable than it is right now. And part of that is figuring out if it's actually making the amount of money that the seller slash broker claims it is, because sometimes the claims are a little bit iffy to say the least. So a repositioner is finding different ways to find that upside. And the most peculiar way, I'd say, of finding upside is that they're always going to have a big circle of financiers. So that's lenders, that's investors, people who are dealing with paperwork, the owners, and capital. They are not dealing with any kinds of toilets that are clogged or termite infestations, anything like that. No calls in the middle of the night. They're just taking care of those parts. Now the repositioners have to have that network of financiers, not only because this is a capital intensive industry, but it's because if you can secure a more advantageous loan, aka cheaper money, that's going to go straight to the profitability of the building. So that is why you need to know lots and lots of financiers. Anybody who's involved in real estate is interested in meeting new investors. But the more intuitive spot that a repositioner is going to find upside is they're going to take a look at the operations and say, hey, what's with all these Benjamins that are going down the toilet? And of course, they need to get that fixed right off the bat. Now, if you're like me and you focus on bigger properties, we're talking, 100 units or more, something like that, then you might be outsourcing the property management and operations to a third party. And so then the question is like, well, what does a guy like me end up do to contribute to the GP teams? So my technical background means that web-based applications, inventory, and that sort of thing are within my purview of experience. But also you have to understand that vacancy is the deal killer. Vacancy is the enemy. So if that third-party property management company can't get the units filled, you need somebody like me with serious marketing chops to get those units filled. So that's where I throw my hat into the ring on a GP team typically. But there's only so many efficiencies and whatnot that you can find in operations. So frequently the next place that the repositioner will look is they'll get a contractor team involved to renovate the property, make it nicer so that future residents will be more than happy to pay more in rent than the previous ones. But if only things were that simple. See, I don't know if you're like me or if you know this, but I'm from the internet. And that means I need locals. I need boots on the ground who can be there in an hour or two, because that will not be me. I'd still be stuck at an airport in an hour or two. So I definitely rely on people who live nearby, who can keep an eye on the contractors, make sure that they're keeping the schedule, make sure they're not using subpar materials, make sure that they're not off the site doing other jobs all the time, things like that. And then also making sure that the operations team, the property managers, aren't misrepresenting the state of the property. Now, of course, the sixth and final role, if you have a guru or a mentor or a coach or something like that, I encourage you to listen especially carefully to this next part, because let's do a hypothetical. Let's say you're an engineer or an attorney or a physician, and maybe you have a few rentals of your own already. So you go, okay, I know how this works. I get the deposit and I borrow the rest. So you see this building down the street, it's 350 unit apartment complex, and you say, hey, if I go to the office or the hospital or wherever you work and you hit up your colleagues, say, if we all pool in 100K each or something like that, I bet you we could take over that building. So full of confidence, you turn around to the banks, the financiers, and you say, I want to buy that great big building over there for tens of millions of dollars. You don't happen to have, say, tens of millions of dollars you want to lend us, do you? Well, they're going to stop you right in your tracks right there when they ask you the question, who's your sponsor? Who's your KP? What's that all about? You have to remember that lenders are in the business of protecting their capital. So they can't just be lending out money all willy-nilly. And so one of the ways that they do that is they will not consider you eligible for a commercial loan if you don't have somebody in the fold who already owns a similar asset. In other words, if you want to borrow money for a 350 unit apartment complex, somebody on the GP team has to already own a 350 unit apartment complex. They'll have the confidence then that you can actually run the place without losing all the money. So on top of that, you also need a certain amount of liquidity, proving that you can operate without going into the red. And then among the GP team, you need collateral, aka a balance sheet of at least the amount of the loan. But if you have all those pieces, you got yourself a commercial real estate deal. So Paul, Amy, as far as those 6 different roles, what are the key parts that you expect to be involved in?
on a team. Well, I think that
Well, we definitely are the repositioners. We are looking for deals. We're finding them, and depending on where the market is, if it's in our backyard, and I don't mean like literally, not necessarily in our city, because our city is
San Diego, California is
our backyard could be Arizona, Phoenix, Tucson, Northern California, Central California, lots of places, but places that we could still get to very easily. So we could also be boots on the ground in some ways, in some capacities. But we also have close connections with people in those areas too. So I think that those are probably the areas that we're not KPs right now. Nope.
We have good connections and relationships with those. So, that's why looking for deals, some people also are sending us underwriting, and, we're helping out, getting introduced to sponsors, because, sponsors don't want to, I'm not going to say babysit, but they don't want to go through underwriting that maybe it's not making sense and it's not something they want to do. So, yeah, we're on.
So I guess that's a pretty Dan Does Deal Cube role, because we like to work with people and help them see where they could get to become a repositioner and get to a sponsor. And even that could lead us to working with them as well. So,
and that's one of our give backs, because there are people out there that trying to, get in the industry, and that, as your cube says, it had actually, there's probably way more. You get the 8 dice or 9 dice, those ones. There's so many. You have investors, you have broker relationships, you have underwriting, and then you want to get on a team. So there's just so many values that you could learn in this business, and I think being 2 for 1, we actually offer almost a lot of those opportunities, except for sponsorship. But we're getting there. That's why. As getting on a team, you get that after 2 years of being an operator. That's the first step, and so we're right there doing that.
I love it. I love it. So let's talk about buy box. And when you're asking about what's your ideal property, Paul and Amy already mentioned a few different details, like which states. There are some details that you absolutely have to include. First one's geography, as I was mentioning. So which states, which counties, possibly even which neighborhood, it's absolutely going to matter. But the second one is size. Now, when you're talking about multifamily, the apartment complexes, we usually go off of the apartment unit count, or unit count for short, to figure out the size. The reason why it's relevant is because the type of group that's taking over 5 or 10 or 15 unit apartment complexes, they're going to be fundamentally different from the ones that are focusing on 100, 150, 200, 250 unit apartment complexes. Now, of course, there's other types of commercial real estate like warehousing or industrial, where they'll go off of a square footage rather than unit count, but the size constraint still applies. So that's the second one. But the third one, people usually use the term class. I prefer the term desirability, because it's more than just a single feature. Though actually, if you take it apart, I find it's 2. One is desirability, and then the second one's area. So if you're talking about the condition, when you're talking about desirability, the condition is how recently has it been built or renovated, how nice is the place, what sort of luxuries or amenities are included when you are renting in that location. So that's the condition. Whereas the area, there's the old broker trope of saying location, 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 when what they really mean is traffic, traffic, traffic. If a place is busy, it's going to have more implicit value than a place that's not. The second consideration is crime rate, where the property is located. That's always going to matter. But since we're usually talking about residential on this show and multifamily apartment complexes, the school districts where the property is located are also going to be highly relevant. But both the area and the condition of the property are ranked the same way as in grade school. So when they're talking about class, they'll talk about A+, then A, then A-, then B+, and so on. So Paul, Amy, do you want to give a little bit more details in your buy box?
Sure. So depending where you are in your journey within the multifamily, like you were saying, so our strategies coming into some of the markets, we want to fly below the institutional money because of the competition considering putting in an LOI on a property, if it's 50 units above who you're competing with. So certain areas I'm 2 or 3, 4, 5 LOIs versus 15 to 20. So our strategies are try to come in maybe in that buy box of 20 to 40. So it gives us a more of an opportunity. And then, that broker relationship typically that we built in that specific market um, um, creates deal flow. So showing that we have the ability to close, open, close, go full cycle, basically the broker or most of the brokers in that area are gonna just start sending us deals. Like you mentioned, off market opportunities. It just goes from there. So I agree that some people like to look in so many markets, and that can be good and bad. That's great in this world of the internet, right? But to get into one and stay and focus and learn about the market, see what's coming in, and then get deal flow. I think it's a great strategy for maybe someone starting out. If you have partners that are, 50 to 150 and all that, don't get me wrong, but you need partners to get into those type of situations. So
yeah, to add to that, 20 to 50 is good. We do look above that, but we don't go into the 200s. We're right now really are focusing on the probably 40 to 80, I would say. We'd go.
Yeah.
But that, again, depends on the market. We also like B and C areas, A, B and C areas, and we'll go with B and C class or style. Definitely the vintage matters. We always think about the exit, and we also think about our investors. The exit meaning, okay, we're going to be a 5 or a 7-year hold or even a 10-year hold in some cases. Is that if it's one vintage, is that going to be desirable to sell 10 years from now, 7 years from now?
Like it could be 100 years old by time,
depending.
60s, right?
About, Victorian, and there's a whole other niche of that. That's not what I'm really referring to. That's its own style, and people are specialists in that type of investing. We're talking more just what's going to be attractive to be able to exit, and also what's going to be attractive to our investors. We have our investors in mind. We have various investor classes. So what is it they're looking for? What do they want? What kind of apartment or living or community are they going to be interested in investing in? So those are the things that we keep in mind for sure. And we like to do value add. Value add piece is really an important piece of building a community. We don't just work on apartments. We like to build communities. We like to make it a place where people want to live, and we can improve the quality of life for people.
Yeah, we have one right now. It's townhome style, but 3 bedrooms, 2 bedrooms, but like they have little gardens in the back of their house. There's the kids are out. So, and some people cannot afford a home, right? And so that the apartment is their home, and so we also like to make sure that we're building community within our assets.
I love that answer. So the next question has to do with people, which is my favorite part of this industry. Now, maybe it's because I came from tech where we're kind of famous for being a little bit on the antisocial side. But when it comes to commercial real estate, people are always eager to give referrals, build new teams, and I think it's because it's multifaceted. Nobody's realistically going to be all 6 roles for any meaningful amount of time. They're going to focus on 1 or 2 sides of the cube and not really try to diversify and do too many things at once, because they're kind of setting themselves up for failure. But because we have those unique skill sets, we tend to be better suited to helping some roles than others. Of course, everybody in real estate, because it's capital intensive, they're going to be looking for more relationships with investors, and I'm no different from that. But I find, because of my marketing and my technical background, the sponsors and KPs are the people who I can help disproportionately. In other words, if you're just looking to be a repositioner or something like that, you need people who have the ability to put in 80 to 120 hours a week. That's not where I'm making my biggest contribution. I'm more of the make a difference of, like 3% when you've already got an enormous foundation figured out there. But as far as you two goes, which roles do you find you're most able to assist? So who are you looking for in the audience?
do find, so the value for us in working with ourselves as a team, and then with working with, more people in a team within ourselves, we've learned our strengths, not necessarily our superpowers, because I think they have a variety of strengths along a spectrum of superpowerness. So Paul definitely is a really, really great networker, and he works really, really well with brokers. I can communicate with brokers, but I'm kind of like, here's what I need to know. What can you tell me about this, black and white? He's very, very much a relationship builder, I would say, around that piece. But I like to, so when it comes to helping others, we find ourselves where he's working with people, people trying to get into this work and learn more about this. He finds himself helping people along. Hey, let's get on a call together. Let's talk to this broker. Let's see how this goes. And he's kind of doing a little bit of coaching in that respect, and that he finds a lot of value in that, I think.
Yeah, I mean, on that note, like, honestly, that's great. Like you were mentioning, the tech world, maybe introvert is the word. So trying to get some people out of their shell a little bit. I'm actually in the dental field, so my business, I talk to dentists a lot, so it's comfortable for me to kind of talk to people. But like, as far as broker relationships, to be honest, having an underwriter that's with you, giving feedback to brokers is one tidbit I will say to anybody out there, is that brokers are looking for feedback, whether it's, that deal's not meant for you, but they want to take that back to the seller. So that might be our buy box, that why it doesn't work for us. But my communication with brokers, typically it gets much deeper once your underwriter has done something and we start going through some things we see, whether it's in the, parts of the underwriting, and that opens a communication that's valid to that broker, because he can take it back to the seller, or it shows who you are, your credibility, and what you're doing. So I think that, I like doing the broker talk, but just not with underwriting. It adds a little more value. That's how those relationships that I've built have come off of the underwriting and deeper conversation.
And along those lines, because I'm an educator at heart, so an educational leader and also a teacher. I find a lot of value in helping others understand the underwriting piece, because that's not that's multiple layers in doing really good deep underwriting that matters, that really can help you understand if there's a value in an asset or not. So I get a lot of enjoyment out of helping other people kind of learn the nuances of underwriting. So that's some place where I've been working alongside people and coaching. I guess it's just not even coaching, but just working alongside them, helping them understand things, and to hear them say, wow, this is so valuable, that I'm helping them understand things that they might not otherwise be able. It could be a barrier to them moving forward, and I get a lot of value out of helping other people so they can push through that and get to the next level. And then when he's able to help them take those numbers, then touch base and connect with brokers and communicate like that and get responses, and then build relationships that together just really feels like we're helping others, and we appreciate that opportunity.
Getting through fear, because fear is a real thing, and it can stop the best of you. So I could just say, if you can get through fear, then it's amazing what the brain can do once you get past that piece. So that's, I guess.
Yep, I love that answer. So, of course, I'm sure there are plenty of people in the audience that are thinking, how on earth do I reach out? I'll sandbag that for a second and talk about myself. Now, fortunately, I have this big, distinct last name. It makes me really easy to find online, especially on LinkedIn, where I spend most of my social media time. So if you want to appear on this show, or if you play chess and you want to appear on chesswithinvestors.com, where we talk about whatever we're investing in or whatever's on our minds over a live game of chess, then connect with me on LinkedIn for sure. Now, of course, I already mentioned dandoesdeals.com, where you can see the rest of these chance encounters. The big prominent QR code, though, that goes to my Amazon author page, where I have a few different books on different business creation and skill building related topics. But Paul, Amy, if people want to reach out to you, what are the best ways?
Oh, we're on LinkedIn. We're
AM Sturm Corporation, Amy and Paul Griffiths at AM Sturm Corporation.
Mhm.
Calendly is the best way to directly hook up with us. We're calendly.com/amsturm, and then of course our website, www.amsturm.com. You can connect with us there.
And yeah, and as you heard, we're pretty versed in many areas, and so we can help out with pretty much any question you have. So we're here for support and also to help you with growing your wealth. So that's what we're here for.
Excellent, excellent. And that brings me to the last part of this interview. It's the public service announcement. So it's not so much for you, Paul and Amy, as for you and the audience. If you've been watching this episode and experiencing searing pains in your eyeballs, like migraine like symptoms maybe, I'm confident it's because of the downright hideous subscribe button that you haven't hit yet. And if you just hit it, then it'll just go, okay. Full disclosure, I want a gazillion people to hit the button so those deadbeats at YouTube start to pay for these videos instead of me. I think that would be amazing. And the trade-off to you, it costs you absolutely nothing. It doesn't ask for like a credit card or any of that ridiculousness. All it does is it means that my videos might show up on your list of suggestions. But you can feel free to ignore those suggestions. Quite frankly, I just appreciate the fact that you spent this time with me. Just like Paul and Amy, I appreciate you joining me. This has been great.
Thank you.
Hit that button.
Yeah.
Subscribe.
Let's go.
We did it a long time ago.
Yes. Yes.
Awesome. Sweet. Thanks.
My background has been in alternative investments for the past 20 years. I've seen just about every type of fund, worked on the accounting and operations side, and even at some of these big banks that I worked for, worked on a lot of projects behind the scenes to really hone my craft and, create Cardinal Financial Consulting and help people set up the right structures, handle the accounting and operations behind the scenes, and really take that away from the CEO's responsibility to make their lives streamlined. Sorry.
Hey there, are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506BME or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye.